Shriram Finance, that's the one which is up almost 8% right now. What an earnings reaction coming in. It's a big beat all across parameters. Let me welcome on board Vice Chakravarti, the MD and CEO at Shriram Finance, joining in on the show right now. Mr. Chakravarti, great to have you today on ET Now. Your AUMs have been consistently growing at 19% in the last 2 quarters. Given that typically second half is better than first half, do you think that you'll be able to beat that 19% figure, and is 20% thereabouts a fair assumption?
Yeah. I think we should be able to do that. Should be able to beat it. As you said, the third and fourth quarters are good seasons for business. So hopefully we should be able to cross this 20%.
You've been seeing growth across segments, right? Your PL, PVs, gold, MSMEs. But the CV segment, that has been a little bit soft. Tell me, what's your expectation about there? What kind of disbursements are you anticipating in the second half? And will the other segments keep firing up?
On the CV side, we have guided for about around 12-13% growth in the beginning of the year. And I think we are on target with that. So CV will grow in these 2 quarters. I think we will be looking at about 15% growth in the CV. But the rest of the segments, being the base is small, I think they will outpace the CV growth, particularly our MSME portfolio. And of course, the one segment that is actually performing really well is the construction equipment.
Aren't you diversifying too much? Because Shriram Transport Finance has always been a specialist in the second-hand CV market. You understand that business, risk, both borrowing and lending. But now you're diversifying into a lot of other segments. Isn't that saying that you're spreading yourself too thin?
I wouldn't put it that way, because after the merger, we also have teams that can handle MSME, gold and two-wheeler. Basically, the merger with Shriram City Union Finance. So Shriram City Union Finance is also doing this business for the last 25-30 years. So we have teams that have expertise in running these verticals. So I don't think we are, even with all that, if you look at it, non-vehicle business is still only 20% of the portfolio.
Okay. When you say second half will be better, I'm assuming that you are referring to the non-CV business, because it is not like that the CV business will become better in the second half of this year. I mean, this has been a natural uptrend throughout the year now.
Yeah, non-CV business. And the CV business, we expect to do well in the fourth quarter. Typically, a lot of corporates and all acquire new stock in the fourth quarter. So we expect CV business also to do well in the fourth quarter.
So in light of that, what is the outlook when it comes to your net interest margins? Because they have expanded on a sequential basis. What is driving this improvement, and do you think they look sustainable at the current levels?
What is driving the net interest margin is 2 things. One is we had liquidity buffer earlier, which we have reduced it to 3 months now, 3 months of liabilities. So that about 2,000 crores came off. So the negative carry has come down, one. Second is the change, the mix of disbursement, in the sense our SME has gone up, which is like giving a slightly higher, NIMs compared to the CV segment. So it's a product change, slight change in the product mix has aided this. And as far as sustaining it is concerned, third quarter, fourth quarter, because the demand and since we offer schemes to customers, particularly in the two-wheeler segment, and of course, going forward, we are also, as a new CV segment is slowly increasing, the NIMs could be anywhere between 8.5 to 8.9. It could be in this range.
Can you grow at 20%, the number which you shared with us, without raising capital for next year?
Yeah, we are at 21% capital adequacy. I think we should be comfortable. Probably next 2 years, we may not need capital.
Minimum capital you need to maintain, because banks I know the number, NBFCs I don't know the number. I'm not aware of it, let me put it
15%.
15%.
Yeah.
Okay. So if you're growing at 20% and your capital adequacy is 21%, that means for at least 3 years you don't need capital because you'll plow back your profits back.
Exactly.
Okay.
That's what I'm saying.
If that happens, then what happens to your return ratios? The return on equity should go higher because if you're growing without diluting, then return on equity
Yeah.
should go higher.
Correct. The ROE should trend up.
I'm learning the tricks now. How to analyze
around-
NBFC. I'm learning the
Sorry?
tricks now how to analyze NBFC businesses. Okay. So then what happens when you are, what is your leverage ratio right now? I mean, in terms of the balance sheet leverage.
I think we are at about 4.5 times, roughly. 4.5.
Isn't that slightly high?
Oh, I think no, probably. See, if you look at it, we will be comfortable at about 5.5. Around 5, we should be okay.
Which means that you can then be 20% because if you're looking at taking leverage higher and growth is looking strong, that means 20% is the base. I mean, then you should be giving us numbers which are north of 20%. I mean, looking at what you just told us.
I'm sorry, I didn't get you.
No, sir. I'm saying that you have a leverage which is comfortable. You want to increase your leverage. You're talking about a 20% growth. But
Yeah.
looking at how positive you're sounding and the festival season is around the corner, that means the second half of this year, you should actually give us numbers which are north of 20%.
Possible, but see, what I'm looking at here is one. This 19% is aided by mostly by my growth in passenger vehicles, construction equipment, and MSME segment growth, where I would like to take a slightly lower targets on the passenger vehicle as well as the construction equipment. MSME will still grow at the same rate. So looking at all this, conservatively, I'm putting it at 20%.
All right, appreciate your time. Glad you could join us and certainly hope to see much more of you going forward. It's the stock of the day. Shriram Finance, yes, no, yes, no. There was a lot of overhang. Now the merger has gone through, new businesses are getting added, cost of liabilities is getting better, and NIMs are going to expand. So it's a stock to watch now going forward, and that's what most of the brokerages are saying. Let's take a break with the news that markets are looking steady. A gap up start which is sustaining, and the breadth is looking powerful once again.